Welcome, everybody, to another Smart Home Choice podcast. My name is Gary Hibbert, and on this call, I get a chance to sit down with Kathleen Vandenberg. And Kathleen is a certified financial planner who believes there are many aspects of traditional planning methods that are fundamentally flawed. And the good thing with Kathleen, and I mean, look, I've sat down with a lot of different financial advisors, but she looks at things completely differently, which was very refreshing, and it was a great call. I really enjoyed it. So I'm not going to talk a whole lot on the intro. Really what I want you guys to do is to be able to sit back, relax, and understand what Kathleen is preaching on this call. So I hope you guys enjoy, and I will talk to you guys next month. Take care. All right, so we are live, and on the call today, we've got Kathleen Vandenberg. So Kathleen, thank you very much for joining. I appreciate it.
My pleasure. Happy to be here.
Yeah, great. So listen, for the listeners, why don't you give them a little bit of a background in regards to who Kathleen is and what it is that you do?
Sure. I am a wealth strategist. I've worked for over 20 years. I don't want to say exactly how many years. I won't be dating myself in the financial services area. I have a background in MBA in finance and marketing. Most of my corporate world before I went into private practice, most of my corporate world was with mutual fund companies or investment companies on the insurance end, and training financial planners and marketing their products. I have been a CFP, a certified financial planner, since 2002. And I'm a CLU, which is a chartered life underwriter. It's a life insurance designation since, I think, 2010. And I became licensed planner in 2008. So that's a little bit of my background. I'm a huge advocate of income properties for my clients. And that sort of made me quite different than the average planner, which is why I kind of hold myself out as a wealth strategist. So that's a little bit about me.
I like that. Good. I like real estate in investors' portfolios. I think it makes a lot of sense. And I know for me, when I first started, there was always that fear of how risky real estate investing could be.
I don't think it's risky at all. I mean, I think even stock markets are, if they're a long-term investment, will be fine. But I mean, I prefer real estate portfolios because they just offer clients so much. There's tax advantages, there's the cash flow, there's tax write-offs. I just think it's one of the best things that they can do to provide financial security for themselves, for sure.
Yeah, I can't agree with you more. I 100% agree. Now, in regards to, creating a financial plan, and I think this is where a lot of people may have some difficulties because sometimes they're just not too sure how to do it properly or what's the best way to do it. For you, what's involved in developing a comprehensive financial plan? Like, what is it that you do?
I look at a variety of things when I'm meeting with a client. One of the first things I'll start with is their protection component or an insurance analysis, make sure they have the proper life insurance. I'll even analyze their auto insurance to make sure they have strong liability coverages. I'll analyze their disability. I come across a lot of executives that, a lot of their income is driven not only salary, but bonuses, and their disability is only on their salary. So there's a huge gap there. I'll also do a debt assessment. So I'm looking at the debt that they have and the debt that they'll qualify for, and using that as a tool to kind of catapult their wealth strategies forward. I'll do a portfolio review to make sure that's, A-okay in terms of their risk tolerance. That tends to be minor. Most planners focus on that. For me, it's minor. I'm really focusing on tax optimization. I want to make sure that they're putting their dollars in the right vehicle, given their tax or their tax rate now and their tax rate in the future. I do a cash flow evaluation, and I'm looking for investments that will cash flow. And retirement planning, of course, is integral, or goal planning if people's goals are education or upgrading their home, whatever. So I'm looking at those kind of 6, 7 things.
Nice. Okay, so you're really kind of going right from like A to Z, really, when you sit down with that client, and just kind of just working out that whole entire game plan for them.
Yeah, absolutely. I mean, you have to look at how those different aspects integrate. I mean, I see all the time, I'll see, someone's contributing, let's say, to an RSP, but I see the credit card debt is growing, and those two things are working at odds. Your RSP might be earning 5, 6, 8%, but your credit card's costing you 8, 12, 10. So if you're not looking at everything and how it integrates together, then you're just doing the client a disservice, in my opinion.
Good. I'm glad that you do that, and I think that makes a lot of sense. Now, what would you say are the top key wealth strategies that you would typically recommend?
Well, my biggest one would definitely be borrowing to invest, good debt. I'm a huge advocate of good debt, and I think that's why real estate is generally a huge thing that I'll focus on getting my clients at least into their first income property. It's really using their ability to borrow for other wealth strategies. I recommend cash flow options for them. That might be mortgage investments, again, rental properties. And I'm looking at tax optimization strategies. I'm looking at, the goal is not to save taxes this year, it's to save taxes over their lifetime. So sometimes, for instance, they might be following an RSP strategy when they're in a low tax bracket and it doesn't make any sense. So for those people, a TFSA or an income property would be a much better solution. And I also I'm a huge advocate of permanent insurance as a wealth strategy as well. Just like I want people to not rent their homes, I want them to own their homes. I don't want them to rent their insurance if they can afford permanent insurance. And I use that as a strategy for tax-free income in retirement as well.
Okay. Now you touched on a couple of things there that I thought were really good, but one of them was good debt. And I'm sure there might be somebody there saying, well, what do you mean good debt? There is no such thing as good debt. Can you maybe just elaborate a little bit more on that, and if there's a difference between good debt and bad debt?
Sure. If you're borrowing money to, let's say, redo your kitchen or fund a big screen TV, that's consumer debt, and that's generally considered bad debt. And you can tell it's bad because of the interest rates that you'll pay on it. The credit cards, those are all kind of bad debts. But when you borrow to invest, let's say in an income property, like if you can borrow money at 3% and you can earn in excess of 3%, and most income properties are going to give you a return of somewhere between 8 and 20%, that's great because your cost of capital is 3, but you're earning 8. So you're creating wealth. So anytime you can borrow to create wealth, anytime you can buy an asset that's going to be income producing, that's good debt. And the wealthier have been following that model for forever, right? So
yeah,
I
love good debt.
Yeah, absolutely.
and I think once you get educated on it, understanding the difference, it makes it's such an eye opener.
Absolutely. I wrote a blog once called "Would you work with a financial planner that had $1 million of debt?" And I guess at first glance people say, "Gosh, no, this person has money problems." But it isn't the debt that I have; it's what's the asset backing it. If I have $1 million of debt, but there's $2 million of income properties giving me cash flow, paying for that debt, that's good. That's great. And it's amazing what that does in 5 years and then again in 10. So.
No, that's good. I would love to read that blog. I'm sure a lot of people looked at it and like, there's no way. But, once you understand it, it makes a lot of sense. It really does.
Yes, absolutely.
Now, what would you say are probably the most common mistakes that you see, Canadians make with respect to, their financial planning?
Well, I'd have to say the number one thing would be investing in RSPs. I see it all the time. And, that game Family Feud?
Yep.
Where they say, 100 Canadians surveyed, they were asked a way in which Canadians save for their retirement. 100 out of 100 would say RSPs because Canadians think it's the only way to save for retirement, but it's not. And if my clients are not in the top, if they're not in a top tax bracket, it really is not the right strategy. The only time RSPs work as a strategy, and they're still not the best strategy in my opinion in this case, the only time they work as a strategy is if you're guaranteed to be in a lower tax bracket in retirement. But I think assuming that you will be in a lower tax bracket in retirement is often a huge mistake. I mean, my goal as a wealth strategist is to make you wealthier. I want you to be in a high tax bracket. I want you to pay a lot of taxes, not unnecessarily, but because you're wealthy. So, and I think that the governments are going to be having bigger problems in the future. Like when it comes time for us to retire, they're going to have major issues, and they're going to have to raise the tax rates. Another mistake they do, and we touched on this earlier, is believing that all debt is bad. I believe that debt reduction is not the path to wealth creation. It is absolutely not. It's your borrowing capacity that will turbocharge your wealth. And, you know, if your clients are, for people that are 30, 40, 50, they have a great deal of time on their hands to still be able to harness that borrowing capacity and do amazing things with it. Other things I'll see are people would typically be underinsured, and of course things like keeping up with the Joneses, poor spending habits. My clientele, I tend to focus, I'm more of a good to great financial planner, wealth strategist, so I don't have a lot of people with debt problems. I'm trying to encourage them to borrow to invest. So.
Yeah, no, that's great. Great advice. I remember when Darlene, my wife, she worked at Bank of Montreal, and she was an assistant branch manager. And, you know, some of her clients that were coming in, they'd be like in their 60s and 70s. And some of them would actually leave her office crying, saying, if I could go back in time, I would not put a single penny into RRSPs.
I hear that all the time, and I hear people talk. They say that my mother was saying this. My father said this. I don't want to make this same mistake. What should I be doing? And you know, unless you're in a company matching program or you're in the top tax bracket, save your RSP room for something else. It's just not the best wealth strategy at all. And next time, you know, quite frankly, next time a planner tells you that you should be doing this strategy, why don't you just run the numbers? Like if I invested this in an RSP and it grew at this, what am I getting at the end of the day versus an income property? What am I getting at the end of the day? You have to run your numbers.
Yeah. And you know what? And I guess just for clarity as well, too, I'm not saying not to put anything in the RSPs. What I'm saying is there's such better vehicles out there. And I think that's pretty much what you're saying as well, too. Correct, Kathleen?
You know, absolutely. I mean, run your numbers. RSPs are a great tax tool. They are not a great retirement tool. So if you're in the top tax bracket and you know that you can pull it out at a lower, then it's great. Or if you want to have a safety net, everybody should have a safety net. That's great. You know, I had a client this summer. She got a huge severance package, and because she had $80,000 of contribution room, she was able to pop that in and save herself a ton of taxes. And then she can take that out over time at a lower tax bracket. It's a great tax tool. I just don't believe it's a great retirement and wealth tool when compared to other options.
I like that. You know, I never actually heard it that way before. That makes a lot of sense. That it's a good tax tool, not a good retirement tool. I think that really kind of hits it home. Absolutely.
And again, what I do is I'll show clients, you know, this path versus the other path, and they can make that decision themselves, right?
Right. So let's kind of just go back to the investment properties. And I guess the question is, you know, why do you recommend income properties so often for your clients? Is there something specific within it that you really like?
You know, income properties, rental properties are what I call multi-dimensional dollars. Income properties do more than one thing. They give my clients cash flow now. They can give them preferential taxation when they sell because it's capital gains taxation. They provide tax breaks now that you can write off interest. They provide income in retirement. You can use an income property for your child's education. They're way better, in my opinion, than RESPs. You know, when you look at an RSP or an RESP, an educational savings plan, those are one-dimensional dollars. They kind of do one thing only. So whenever you can put your money in a tool, in a vehicle that can provide so much more, why wouldn't you do it? Why would you lock your money up in money jail? An RSP is really going to do one thing, that's provide income in retirement. But an income property can do so much more.
And then you touched on RESPs. Well, what about that? What are your thoughts on those?
Those, I'm actually even less enamored with those than our RSPs. You know, a child's education, so even if they're a newborn, they're going to be going to school in 17, 18 years, which is, believe it or not, is short term. I run the numbers between an educational plan and a rental property, and even though you're giving up those grants, you will do way better. I mean, the maximum you can put into an educational plan is $50,000, and the maximum grant that they will give your child over their lifetime is $7,000. My income properties have gained way more than $7,000 every year. Every year. So don't confuse the goal, education planning or retirement planning, with the method, RSPs or RESPs. The goal can be achieved in many ways, and income properties are typically one of the best ways. And the other thing is, what if your child doesn't go to school? I mean, I can envision a future with technology and internet that maybe people will be self-studying. Who knows? You know, maybe they'll do a trade and you've locked your money up. And whereas an income property, you don't even have to sell the income property when your child goes to school. You can just refinance it and continue to keep it kind of cash flowing. So again, it's a multi-dimensional dollar vehicle, whereas our ESPs are very one-dimensional.
Yeah, you know what? I know when we first started investing in real estate, we actually had switched over to a new financial advisor, and she was pushing the RESP stuff. So this was all new to us. So we said, okay, fine, we'll do it. And to make a long story short, she just came back to our house a couple of weeks ago to sit down with us and to show us what our RESPs had done. And I'm telling you, like, it had done absolutely nothing, like barely had gone up. And then she wanted to obviously take a snapshot of our portfolio of where we were, and we showed her our investment properties. And back in the beginning, she was like, don't do it. The market's about to crash. And you can see that her jaw almost dropped when she compared what she had put us in for RESPs and what our investment properties had done. You know? Well,
a lot of RESPs are restricted even on where they can invest, and they're forced to invest either all or a significant portion in bonds. And we all know where rates are, right? So you're locking in very low rates, 1-2%. Yeah. You know, and you know, speaking of, you mentioned something about markets crashing, and you know, real estate is high. There's been a bit of a pullback, but if you're going to own an income property for 5, 10, 20 years, I think you're going to be fine. But RESPs, where your child's going to school in 5 years, is a much riskier venture. So
yeah, and I mean, you know, when you talk about, you know, market crash or even correction, I mean, we've had I would say a significant one this year. And if you bought your investment properties with the correct fundamentals, you survived it. And this is a great time to go out there right now and be purchasing investment properties.
I agree. I mean, I haven't analyzed, any of my properties since this pullback, but that's because I don't care. They cash flow, they pay more than their mortgage. And I know that 10, 20 years when I need it for retirement income, it's going to be even better. So when you buy those fundamentals, and that's where I, as an advisor, or you as a real estate agent that focuses on income properties, can help clients analyze these properties for cash flow and all those fundamentals, good locations, rentability, and things like that. They're going to be fine.
Yeah.
And I do think this is a little bit of a window right now.
I'm so glad you actually said that when you said, I haven't looked at my properties and I don't care. And a lot of people are like, well, what do you mean? Like, aren't you buying your investment properties for appreciation? And I know when I get that question, like, I'll take it, but that's not why I'm buying it. I'm buying it for the cash flow. And then I'll just take the appreciation as it comes because I know it's going to come over the long haul.
Yeah, I mean, I would say I'm buying for cash flow and appreciation, but it's long-term appreciation. I'm not, it's not like a stock portfolio where I'm going in and checking the price of my Royal Bank shares every day. It's doing great. I mean, I look at different things. look at my mortgage statement. Every month, my mortgage is being paid down over $500. That's savings, right?
Yeah, no, it's there's so many different ways that you're making money off an investment property, right?
Mm-hmm, mm-hmm.
Now, you mentioned that you look close at your client's debt when you're sitting down with them and you're reviewing their financial plan. What specifically are you looking at?
Well, of course, I'll look at any consumer debt that they might have if they're struggling to pay that. But more than that, I'm really looking at their borrowing capacity. So could we borrow more or extend the mortgage to be able to raise $50,000 or $100,000 to buy an income property? Our ability to create deductible debt, right? Because if we can borrow off of our, let's say, principal residence, like refinance our principal residence, and we can borrow at 3, for example, after tax, that might only be 2 if we're in a 33% tax bracket, for example. So I'm looking for the ability to create deductible debt. And I'm also looking at how their mortgage is structured. When is it coming up? Is it readvanceable? Do they have lines of credit? So I'm looking at all sorts of things with respect to their mortgage as well.
Okay. And then while we're on the topic of mortgage, what should we be looking at when it comes to choosing a mortgage product for either, it could either be our principal residence or even like an income property?
Well, I know that most people focus on rate, and in my opinion, rate is probably the least important factor. I mean, all the banks and credit unions the rates are very, very, very close. So what I'm looking at is what would the penalty be if I wanted to sell my property or refinance it? How flexible is it? I want to know if it's readvanceable. And by that I mean, when you pay down principal, does it free up line of credit room? Because that way I wouldn't have to refinance my mortgage, and I'll save legal and appraisal fees if it's readvanceable, and it gives me access to more money to do other wealth strategies with, either that be another income property or whatever, other wealth strategy. So having it being readvanceable is a big thing that I look at. I also try and get the longest amortization possible. I'm very often recommending a 30-year amortization, because what that means is that the payment is lower. And I know people say, well, yeah, you'll pay more interest over the long haul. Yes, but if my monthly payment is lower, it means I can qualify for more debt and purchase more wealth strategies like income properties. And right now, with the mortgage rules, a 30-year amortization is actually a bit higher rate, but I'll pay the higher rate if I can get that, because I know it'll help me qualify for more properties.
You know what's so interesting, as I'm sitting here and I'm listening to you say all this stuff, because it obviously makes so much sense to me. But if somebody was tuning in for the very first time to my podcast and was listening, saying, well, hold on a second, you want to qualify for more debt, you don't want the best interest rate, and you want to take the longest amount of time to pay off a mortgage, like it's so opposite from what we're taught in the beginning.
I know. I mean, I have a Dutch father myself, and the advice we were always given is pay off debt, don't borrow. But if I guess to summarize it is any time I can borrow at 3% and earn more than that, why wouldn't I do that? And if it's tax deductible, which it should always be for a wealth strategy, well, my rate is probably closer to 2. So I know I can get a return higher than 2%. In fact, I know I can do better than 8. So if I can borrow at 2 and earn 8, I do that to the cows come home. I do it over and over. And it's just sort of been proven. It's just, time will just make my wealth grow because of that.
Right. And can you kind of maybe share the numbers that you're seeing with your investment properties? So, if you're saying that you can borrow at 2 to 3% in that range, somebody who's used to the stock market may be making, 5, 6, 7, 8%. What's an investment property typically going to give you a return on your investment on?
Well, like the past has real estate has been on fire, and the returns have been, I don't even know, it could be 50%. It's crazy. But what I'm typically looking at for my clients moving forward, if I can sort of answer your question that way, is probably a return expectation of around 20%, which I know to a lot of people sounds crazy. And, any financial planner that was saying their mutual fund would earn 20% would be crazy, or they would assume it's super high risk. But this is how it goes. If you purchase a property, let's say for $500,000, you have to put, let's say you're putting 100 down. But if that property goes up by 10%, let's say it takes 2 years to go up by 10%, it's gone up by 50,000, but you only put 100 down. So you've made like a 50% rate of return over 2 years, so a 25% rate of return each year. Now, what I haven't taken into account is the expenses, so the mortgage expense, property expenses, utilities, but we are always looking to make sure that the rents would cover that and generally give you cash flow as well. So my expenses are typically covered. So because it's leveraged over the long term, if you're just earning even 3%, if the property even just goes up by 3%, you will get a 20% rate of return over the long term. So typically there's 3 things I look at. I look at cash flow, which is about 3% of my down payment. I look at profit, which incorporates not money that I get in my jeans. It's money that's paid down, principal that's paid down. And I'm generally looking for a return, a profit of 8 to 9%. But then if I just add about a 3% appreciation, those properties would be projected to earn about 20%. And if properties appreciate more than 3%, I'll do better than 20%.
Yeah, and using that 3% appreciation, I mean, that you're being obviously fairly conservative, and I'm sure you're probably also putting in your soft costs with your property management. Yep. And an interest rate that was a little bit higher than what you actually really got, and vacancy and all the other stuff that come along with it, right? So yeah, I mean, I know you're being conservative with those numbers. So, but if you're not investing in real estate today, and you hear 20%, sometimes you step back and like, that's not possible, but it 100% is.
It 100% is. Like I said, your property would typically only have to appreciate 3%, which is very, very doable for you to earn a 20%. And even if I'm wrong, right? Like, what if you got a 10% rate of return? Would that be so bad? Really? But I mean, I think a 20% is very realistic, especially in the long term.
Yep. No, I can't agree with you more. So now you've got somebody who's listening to us. How do you help, your clients or somebody that's, listening to the call today to take the first step into owning an income property, and what's involved in that?
Well, I mean, what I do is through my sort of comprehensive financial plan, I would, in analyzing their debt, I'm analyzing their debt capacity. And I would show them, if we did this structure, I build a whole pro forma for them. We get them qualified for a mortgage with, a qualified mortgage agent, preferably someone that is active in income properties. And I actually take my clients shopping. I introduce them to people like yourselves that are real estate agents that are active with income properties. And because when my clients work with someone like you understand what the rents would be in this particular market, or what the height restriction is if you wanted to make a legal secondary suite, for instance. So there really is a bit of a specialty for income properties. So, that's about it. I mean, it's really qualifying them and helping them choose what type of property.
Right. And when you're doing that, do you find that there's a bit of resistance sometimes, or because sometimes it's such a brand new world to them?
There's a huge learning curve, I will say, for those in income property, and there's a lot of questions, what if the tenant doesn't pay, or how do I find a proper tenant? Where do I advertise my property? Where do I get a lease? These are all the types of things that people like you or I would help clients with, right? So there is a process. There is information that you need to know. And so when you work with someone that's experienced, I mean, I myself, together with my husband, we own 5 income properties. So we own duplexes. We have a condo. We built a purpose-built duplex. We have a rent to own. So there's a lot of experience there that they can, take advantage of, people like ourselves, the information that we have.
Right. And it obviously helps because you do have investment properties. So you've gone through, I guess, some challenges that you may have, faced, or, some of the success that you've had in it as well, too. So it's good.
Yeah, absolutely.
Yeah. So let's switch gears a little bit here. And I know earlier you had mentioned that you're a huge advocate of permanent insurance, and maybe if you can explain what that is and why are you an advocate for it?
Well, permanent insurance, in my opinion, is so much like a rental property. It's not even funny. Like, it's that multi-dimensional dollar again. So permanent insurance, so you've got term insurance, which your rates might be good for 10 or 20 years, right? And then they skyrocket, and then it expires at age 85. And it's probably way too expensive at age 65. Permanent insurance, you can pay for 10 or 20 years, and it will remain in force. So it gives you the insurance that you want and need now, but it's also an asset that you can borrow against. You can even use your permanent insurance, the cash values in your permanent insurance, to purchase income properties, and it would still even be tax deductible. It's also a very valuable tool in retirement. I think people underestimate the impact of volatility will have on their retirement savings. So what you can do is you can draw on your insurance, for instance, if the market was down. Or let's say the real estate market was down and you didn't want to have to sell a property. You can use permanent insurance, the cash values, and take money out of that tax-free, right?
Interesting. So sorry, what about term insurance? Can you take it out from term, or no? Only permanent?
No, term insurance has no cash values. So you can never change the payment. You can never take money out. It doesn't ever grow in value, whereas permanent insurance would appreciate just like a property would appreciate. It's just another lever, right? Like, we're going to do a bunch of wealth strategies with my clients. We're going to do income properties. When they're wealthy, we'll do RSPs if they're in top tax brackets. We're going to do permanent insurance. We're going to borrow to invest. We're going to pay down principal residence possibly and use that in retirement. So There's a bunch of different levers, and permanent insurance is one of the safest levers that you can have, right? Because it can never go down in value, whole life insurance.
Damn it. So my financial advisor gave me the wrong advice 10 years ago. See, I'm in term insurance.
Well, you're young, you're healthy. We can fix that.
We're going to have to. We're going to have to, for sure. Let me ask you just, I guess, maybe more a personal question. And I've asked this question before. Financial education. Why is that not taught in the schools? I mean, it's such an important thing that you would think that they would want the kids, that leave high school or even college or university to be prepared, to understand what a mortgage and interest rates are and all that other stuff.
Yeah, I wish I knew. I mean, I wish when I think about the amount of time we spend getting a driver's license and the amount of time, and how easy it is to get a credit card and the damage you can do with a credit card. I don't know why. I will say, though, I am impressed that they are starting to teach things like that, like credit scores and things like that. But it's I don't know. It's an archaic system.
Yeah.
I think that and it's a real problem with society. We're taught to, get good grades, go to university and work, be an employee. But the reality is, I'm 51 myself, and I see it all the time. I see people in their 40s and 50s, and they're being packaged out. And what are they left with? Only you can save yourself. Save your financial self. And what business can people start that's easy to start, like a real estate portfolio?
Yeah, and I mean, we see that all the time where, somebody thinks that they're going to be with that company until they retire, and then all of a sudden they get an early package at 50, and they've only got that one skill set.
I know,
and it's difficult, to get back into that workforce.
Yeah, well, my husband got packaged out in February, and we couldn't care less. We're good. We've got cash flow assets. He wants to do more stuff with income properties, and we can withstand that. But how many other people can withstand that, a job loss at that age, at 50?
Yeah, and that's a great place to be. Knowing that, if you lose your job, you're okay. Obviously, maybe, you can't do everything that you were doing once at the job. But here's the other good thing as well, too, is that even though he doesn't have that job, he can still continue to purchase investment properties through joint ventures and other avenues, right?
Yeah, we're investigating that in a little bit more detail right now, actually. Yeah. But still, it's not that he's not working. He's still really active. He's doing stuff with the income properties. But at some point in your life, and you don't always get the choice, you switch from, body at work to assets at work.
I like that.
Right? And anything can happen. You can have job loss. You could become disabled. But if you haven't built assets at work, and I don't know what asset could possibly be better than an income property in terms of at work for you, paying down the mortgage, creating cash flow. You're going to have to make that switch. You might have the choice, retire, and when you choose to retire, and it will be there for you. But we don't always have that choice.
Yeah,
it's chosen for us sometimes.
Well, that's great. Well, and when did you first get into real estate investing? How many years ago?
I got into it in 2008. Okay. It was an interesting story. I worked for the corporate world. They moved me out to Calgary, and then they packaged me out of my job, and I was snookered. I mean, we couldn't sell that house in Calgary for love or money. It was on the market for 9 months. We both didn't have jobs. We came back to Ontario, and I just said, never again. We've got to take control of how this is going to work, because if we ever get packaged out again, we were literally we were 41, I think, and living in my parents' basement. Literally. I don't know. Somebody was going to be murdered. My father, my husband, I wasn't sure who was going to go first, but we had to get out. And we bought a triplex, and we lived in one of the units. We lived for free. And that was what kind of catapulted everything.
I love hearing those stories because a lot of times people will see where you and your husband are now and say, oh, you guys are so lucky, but not realizing, all the legwork and what you guys had to go through to get to where you are today. So that's great to kind of get that background story.
Yeah, no, it's, was 2008, literally jobless, homeless. And now we've got 6 properties or principal residence and 5 income properties.
Amazing. So listen, Kathleen, thank you so much for sitting down with me today. I learned a lot in this call and also a lot of stuff also just to reinforce as well to what I've already, known and have been taught over the last 10 years about real estate investing. So thank you for that. I appreciate it. And what I'd like though is there something that you can kind of leave the listeners with, just one last piece of advice, that you would recommend?
How about, I'll say this again, I said it earlier, debt reduction is not the path to wealth creation.
Yeah, that's great. Thank you very much. And if somebody's interested and they want to reach out to you and get some advice from you and maybe kind of help you do a whole financial plan or a little bit of snapshot, what's the best way for them to reach you?
My email is VWS, so Victor Water Sam at live.ca. I also have a Facebook group called Durham Money Matters. You can reach out through there. That's a good group to join. And be in touch. I'd love to work with clients that are actively trying to do something better. I mean, people who feel like they're doing all the right things but not getting ahead, and we can make huge impacts for them.
Great. And we've also got you coming out in a couple months as well too. So if people listen to the podcast and they want to see you live and in action, they can definitely see you out here in Ajax in a couple months. So looking forward to that. I think it'll be a lot of fun. And thanks again for doing this podcast. I think it was great, and hopefully it opens a few people's eyes on some different strategies that they can put in place to really create a great future for them and their family and kids.
Yeah, there's just not a lot of financial planners talking about this stuff. So it's a breath of fresh air for a lot of people. So I hope they do come out to your event when I am speaking. Again, I'm very passionate about this. So I thank you, Gary, for the opportunity to help me get the word out. So I think it really benefits people. It really, really does.
Great. All right. So Kathleen, thank you very much again, and have yourself a great day.
You too. Bye-bye.
All right. Take care. Bye. Thank you all so much for joining this month's podcast. I hope you guys really enjoyed the content. Don't forget to check out smarthomechoice.ca to learn more about real estate investing and how we can help.